Hello and welcome to the latest episode of On the Money, a weekly look how to make the most out of your savings and investments. In this episode, we're focusing on an asset class that behaves differently from shares and bonds, and that asset class is infrastructure. Joining me to explain what this investment area can add to a portfolio is Donal Reynolds, Fund Manager of Aberdeen Global Infrastructure Equity Fund. So Donal, to start off, could you give an overview of the infrastructure sector? How many companies are there in the investable universe, and what are the main subsectors within infrastructure?
Well, thanks, Kyle. Thanks for having me here today. Yeah, so infrastructure is an interesting one because in a way, you kind of know when you see it. There's a physical, tangible aspect to infrastructure. But from an investment perspective, you can kind of define it pretty well, okay? So when we look at infrastructure, we think of it in four broad sectors. So we start off with utilities. So think of just your classic electric utility, gas utilities. We have like power generators in there as well, and renewable power players there too. The second sector we look at is transportations. So again, railroads, roads, airports, ports, basically any way we get around or move stuff around the world. The third sector we look at is communication services. And that primarily is cell towers and some data centers in there. And then finally, the fourth sector we look at is energy. And then when we look at energy, it's just important that we make the distinction that this really is just the pipelines that move gas and oil around, primarily in the USA. So again, we really try and minimize commodity exposure there. We look at companies like high quality companies with take-or-pay agreements. So we really aren't we're not exposed to like the BPs of the world or oil price exposure or gas price exposure, just to clarify that point. So that's kind of broadly how we think about the infrastructure universe. Some funds you'll see are narrower in focus. Some of the indices are more narrow, but we feel you need to be as broad as possible to really be able to invest in the secular drivers across the globe that we see in infrastructure.
And in terms of how broad the sector is, are there thousands of companies to choose from?
No, it's reasonably narrow. And again, we take probably the most broadest view, if you will, across the sector. So we have about roughly 400 stocks in our universe. And we have a kind of a quant screen that sits on top of that. So we can kind of look at it from a valuation perspective, performance side of things as well. But I think another important thing to look at when you think about infrastructure stocks and like how they're different from, say, traditional stocks or other asset classes. So we have this kind of like a mental checklist of like the key attributes we look for in infrastructure. And I think that'll help like kind of differentiate what infrastructure really is. So the first one is it essential? Yeah. So then we think about, is it a long life asset? Then are there high barriers to entry? Then we look at, is there a stable regulatory environment kind of around the asset or that controls the return environment for that asset? We look to see if the cash flows are stable and predictable. And then finally, are those cash flows inflation protected? So when you put that all together, it kind of gives you a better view of what infrastructure is and how you can kind of, say, delineate infrastructure even from something like real estate, which when I started looking at this sector initially, I was confused, well, is this real estate or is this infrastructure? So when you go through that mental checklist, you kind of say, well, say, for example, real estate, like obviously doesn't have a regulatory structure around it. There's generally not high barriers to entry within real estate. The returns can be stable, the cash flows can be stable, but there generally isn't inflation protection. So when you go through that checklist, I think it becomes very clear what infrastructure is and the kind of the very attractive attributes infrastructure has as an investment opportunity.
And in terms of where infrastructure potentially sits in a portfolio, it's considered to be a defensive asset that can provide greater levels of diversification rather than investors just focusing on shares and bonds. Could you shed some more light on why that's the case?
So I think there's a couple of things I pointed there. So first, to that point I made earlier on, they're generally physical assets. So there's a kind of more tangible aspect to them. So they have, maybe a more tangible valuation. So the volatility in that valuation would probably be less than, say, a traditional stock like a tech stock or a bank or financial stock. I think the other reason why the correlation is perhaps lower to some of the other asset classes. So if we think about the three main asset classes out there, so you've got your equities, bonds, and let's throw alternatives in there because it's still a decent size asset class. And if we think about infrastructure, it has kind of components of each of those. So it has growth as in equities. It's got an income component like a bond, and it's like a tangible physical asset like alternatives. So it's kind of a blend of the three asset classes. So that kind of takes the edge off the correlation to each one, if you will.
Is there anything further you would say for investors who are just considering bonds and they think, actually, for my defensive part of the portfolio, all I pretty much need is bonds, particularly low-risk bonds, such as, at the moment, for instance, money market funds are offering yields for around 5%, and they're investing in very low-risk bonds with short maturities?
So I think that's an interesting question. And I think when you look at infrastructure, it has a lot of the attributes of a bond. And in fact, sometimes infrastructure is called a bond proxy. But again, I'd probably push back a little bit on that characterization for two reasons. First is capital growth you get within infrastructure. So within infrastructure, exposed to some pretty mega secular drivers around the world. So you've got, increased urbanization, you've got the energy transition, you've got digital acceleration, AI, all these things that you've got exposure that can help increase your capital base. Where with your bond, you won't. You'll get your interest rate and you'll get your capital back, but that capital won't grow. So I think that's an important first point. The second point is, if you remember, one of those attributes I talked about was inflation protection. So the majority of infrastructure assets have some form of inflation protection in them. And again, I think that's an important attribute to have. As we saw in 21 and 22, when inflation was high, when interest rates went high as a result, you saw bonds sell off pretty hard on that. So in 2021, I think the bond index, I'll reference US here, so kind of US bond indices were down roughly about 30%. Infrastructure was flat. And again, because of the inflation protection there in it. So for me, you get the defensive qualities that you like in a bond. And now they're riskier than bonds. I don't want to misrepresent them here. But you get capital growth, which I think is attractive, and you get inflation protection, I think, which is attractive also.
You mentioned interest rates. We've moved now into a period where interest rates are starting to fall, albeit slowly. How do you expect the infrastructure asset class to fare as and when interest rates are cut?
It's like a falling rate environment from a sentiment perspective. It's a positive for infrastructure names. I think that's undeniable. From a valuation perspective, lower rates, because they're kind of bond-like in returns, lower rates mean higher valuations. So that's a positive. Lower rates lower the cost of capital. Infrastructure are very kind of heavy debt reliant to build them out. So lower cost of capital just kind of increases activity and kind of lowers the barriers for making those investments from a private and a government perspective. So overall lower rates are positive. But again, I would say it's a little more nuanced than that as well. And the reason I say that is that interest rates don't happen in a vacuum. Yeah, so they're influenced by macro trends. They're influenced by inflation. So again, we saw rates go higher in 21 and 22 due to higher inflation. And again, you would think if rates go higher, then if it's a bond-like investment, they should underperform. But because of the inflation protection, I think that's why infrastructure was attractive in that case. And again, the nuance around the interest rates is it actually depends on whereabouts in the infrastructure chain you are. It depends on what country you're in. And even within a subsector, it can depend on different types of contracts. So I think it's really important. I think this is why kind of active management is really important with infrastructure, because you can make broad brush statements about infrastructure, but the nuances are actually quite important. And maybe I can bring that to life a little bit, just with an example of a sector. So we invest in tower companies. It's kind of a sector we really, really like. They're great businesses, high returning, they tick all the boxes of all those attributes I talked about earlier. So basically tower companies work by signing master service agreements with the large telcos and have equipment on their towers. In the US, those contracts are set up with fixed escalators. So there's a fixed price increase every year, say 3%. Now they were great contracts to have for the decades leading into COVID when there was essentially no inflation. But when inflation went above that 3% level, they couldn't raise their prices any higher. So those contracts were less attractive. Now in Europe and in emerging markets, the tower companies' contracts are more based on inflation-linked escalators. And again, but once inflation started increasing more, those contracts and those companies became more valuable. So what we did in our funds where we moved some exposure from the US into the Europe and into emerging markets to try and take advantage of that. We still like the overall tower space, but again, so just to show there's kind of nuances there, even within the same subsector of how interest rates, how inflation, how all these variables can impact how important or where you want to be within the infrastructure space.
I wanted to next turn to the three key long-term trends that you're investing in, which are increasing urbanization, the energy transition, and digital acceleration. So let's take each one in turn. So could you firstly talk us through how you're investing in the increasing urbanization theme and provide a couple of stock examples to illustrate?
One of the ways we invest in this increasing urbanization theme is via emerging markets. So anywhere between 15 and 20% of our fund is invested in emerging markets. And if you look at the last 50 years, the population of the world has doubled and the population in cities has tripled. Over the next 30 years, the population of the world is expected to increase by 20%, but the population in cities is expected to increase by 50%. Now, most of that growth that has happened and is estimated to happen has happened in emerging markets and developing markets. And when you have a rising urbanization, you generally have a rising middle class in these countries as well. Not always, but like you kind of, there's better facilities and then there's more consumerism going on. So when all that happens, what do you need? You need more electricity. You need more roads. You need more rail. You need more ports. You need more airports. You need more cell towers to support all the mobile phones in the countries. So again, the increasing urbanization really does cover the full swathe of investment opportunities. Like some names to call out there, say, within emerging markets would be, say, a Helios Towers, which is a UK listed cell tower company, but basic exposure is in Northern Africa and the Middle East, and they're seeing tremendous growth there. Another name that could be interesting that we own is International Container Terminals. So this is a port operator with a focus on emerging markets, with the Philippines and Mexico being their main markets. And again, they're seeing great growth from kind of intra-emerging market flows of goods as those economies grow. But it's not just emerging markets. So there's an interesting theme in the US now as well. So in the southern part of the US, in states like Georgia and Texas, there's urban areas that are growing 2 to 3x the kind of national average. So you're getting kind of intra-US immigration into these states. And again, similarly, as those urban areas grow out, you need new roads, you need more electricity. So we play that theme through, say, a TXNM Energy. So roughly about 40% of their earnings come from Texas, and they're seeing tremendous load growth in their Texas area. I think another interesting name is Ferrovial. So this is a Spanish-listed infrastructure company, but most of their assets are actually in the US. They're toll roads and managed lanes. So managed lanes are quite interesting because they've got control over the pricing. So it's almost like surge pricing on the roads. So there's a lot of leverage in the model. And again, as those urban areas grow, the traffic grows and their pricing grows and the returns get better. So that's kind of the urbanization theme.
So the next theme is the energy transition. This is obviously a huge topic. So how are you playing it and how are you narrowing it down?
Yeah, you're right. It is a huge topic, and it goes beyond just like, say, renewable power. It's essentially the like electrification of everything we do. It's electrification of how we move around ourselves, how we move goods around the country, how we heat our homes, how we cool our homes. So like everything is kind of trending towards electrification, and obviously that drives tremendous demand for electricity itself. And the spending on it is quite staggering. So in 2024, it's estimated that $3 trillion is going to be spent on clean energy. And if we want to hit our goals laid out in the Paris Agreement, that needs to increase to $5 trillion on an annual basis. So like really, really big numbers there. As I said, the key kind of beneficiary of this is increased electricity demand. So that's kind of really where we look to play it, is within those names. And then when we look at these names, we look for materiality of exposure to the theme. We look for, is the regulatory construct around those investments positive, so they can earn an appropriate return on them, or if it's a renewable developer, are the returns, are the contracts in place there to earn the returns. So some names there would be, say, in EDPR, it's a Portuguese listed renewable developer, but it's like 50% Europe, 50% the Americas, like kind of one of the largest ones in the world. So that's a really interesting name to look at from just a pure renewables perspective. In the US, a couple of names would be NextEra Energy. So this is like a 50% regulated utility, and the other half is just a pure play renewable. Great track record hitting the return targets and a huge backlog of projects in the US to build out. And then the other name I would mention there is CMS Energy. So this is a Michigan, US-based regulated utility. And the reason we like that is the regulatory construct around their renewable investments is very favorable, and they can earn good returns on it. There's one other interesting aspect of the energy transition that we've actually looked at it, and it's not on new capital going in the ground, but it's like, how has the energy transition impacted the valuation of existing assets? So we own a couple of names in Europe, Engie and RWE, and within those companies, they've got these things called flexible generation or FlexGen. So these are essentially gas power plants that can be reasonably quickly flexed up and down to help offset the intermittency that's inherent in renewables. So those assets actually have become more valuable in that environment because their earnings have become like larger and they've been able to put hedges in to make those more stable. So again, that's an example of an existing asset becoming more valuable within a company due to the energy transition.
And the third long-term trend is the digital acceleration. So how are you investing in this trend? Are you focusing on companies benefiting from 5G and the artificial intelligence revolution?
Yeah, so obviously AI is a hot topic right now. Like, you pretty much can't get away from it. And every week there seems to be some new higher valuation or some billions and billions of investments going on. I think the interesting thing about the kind of digital acceleration theme is, if we were sitting here like 12 months ago, I would have talked about cell towers. I would have talked about workloads moving to the cloud. I would have talked about towers being like 5G investment, towers being the backbone of this. And that's still the case. All that good stuff's still happening, and we still really like towers. But the AI boom is kind of undeniable. It really has kind of just caught the imagination across all the sectors, not just in like technology and not just energy. And we can sit here, we could debate like how real it's going to be, or valuations inflated right now, but you can't deny that the capex in the ground is real today. So the kind of 50 billion that Facebook, Google, Amazon are spending today is real, and they're going to spend more next year. The power purchase agreements that they're signing in the US are real. So Microsoft, a couple of weeks ago, signed a purchase power agreement for 20 years above market rates that basically underwrites the restarting of a nuclear power plant in the US. So like, all that is real, and it's all tangible stuff that's impacting infrastructure today. I think obviously the big thing about AI is how power hungry it is. So the GPUs they use, so the graphic process units they use, are just so much more power hungry than the traditional CPUs. So like, you see the stats around get ChatGPT search uses 10x the power that a traditional Google search does. So that's a very basic example. But like, every single AI leader out there, like here the CEO of Facebook, the CEO of Microsoft, they all say the big bottleneck for AI in the future is access to power. So that really is kind of driving investments today. And it's an interesting one in that the tech companies that are driving that still want to stay true to their climate goals. So you're seeing a confluence actually of the digital acceleration theme and the energy transition theme, because they want this access to power quickly, but they still want green power. So, and again, like, invariably it's the incumbent utilities that get to spend on this and get the benefit of it. So we're really looking at the companies who are in service areas, because it's predominantly the US at the moment that's benefiting from this AI boom, but it will come to Europe. There's estimates that electricity demand in Europe over the last 20 years has actually fallen 10% in aggregate. The estimates going forward actually is that to start growing again, and that's 100% driven by AI data centers. Like, just today, Blackstone announced that they're going to invest 7 billion in data centers in Spain. And that's on the back of AWS, so Amazon investing 14 billion in Spain as well earlier this year. So again, like, it's coming to Europe. It's just the immediacy impact is in the US. So some names there in our portfolio that we like that are benefiting from that. So the regulated utilities in the US, so the likes of a PPL Energy. So that's a regulated utility. So it's one of its main service areas is Pennsylvania, and they're estimating a 65% increase in load in their area over the next 5 years. Similarly, AEP in Ohio are seeing like a 40% or estimating a 40% increase in load. So like, really big numbers there, and that will need CapEx in generation and in transmission and distribution lines there. And one final angle maybe on the AI transition and the power there is actually, well, the tech companies want it to be all green power. Like, that's just not, they just can't build it quick enough, and because of the intermittent nature of the renewables, they need gas plants. So you're seeing those energy names I talked about at the start, the pipelines in the US, they're talking about significant pickup in demand there as well. So that was an asset that was seen as somewhat like X growth, but now they're seeing tremendous demand, because you have the physical assets in the ground, and it's just a matter of getting some feeder pipes off those. So I think that's really interesting. And just finally on the AI specifically and how important infrastructure is to it. And like one of my favorite things about infrastructure is that infrastructure underpins all the innovation we've seen. So if you go back to the Industrial Revolution, late 1700s, like what helped those mills start like really get scale? It was the canals that were put in place to move the goods around. If you kind of fast forward a little bit to the rail network that helped the steam engines, and you had the electricity sector. Like, so you go through the whole, there's this classic like innovation waves you can see. Each one of those is underpinned by innovation. The innovation is underpinned by infrastructure, which I think is a really compelling reason to be invested in infrastructure long term. Like you don't have to predict what the next wave is or who's going to be the next NVIDIA. You just know that infrastructure is going to underpin that. So like the way I think about it, when you're long infrastructure, you're long innovation, you're long kind of human creativity and ingenuity. And to me, that feels like a good place to be.
You've mentioned lots of stock examples, which is great, as I know that retail investors really appreciate hearing from fund managers what stocks they own to help illustrate their investment process. How many holdings do you have overall in the fund? You mentioned the investable universe around 400.
Yeah, so our fund is somewhere between 60 and 70 names, which is, again, more than normal. I think that our peers are usually closer to the 40 to 50 range or more concentrated, but we kind of feel like, again, to get that really diversified approach and get exposure across the globe and across all these mega trends, I think is important to have capacity in there to be able to put that across a number of names.
Well, thanks to Donal, and thank you for listening to this episode of On the Money. We always love to hear from listeners, so if you've got any thoughts on what you would like us to cover in a future episode, please do get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.